Welcome back. So, could a new super currency really replace the mighty US dollar? Well, any new trading currency would have to meet strict requirements. The currency and the economy it comes from would need to be stable and strong. It should also be immune to fluctuations caused by other economies. The new currency would need to function with as little political interference as possible. And in order to support the global financial system, the central bank would need to ensure that it's an adequate supply. Finally, governments and private enterprises around the world would have to agree to use the new currency. Well, with us are our guests in Washington, Robert Scott, in London, Andrew Leong, and in Paris, Max Keiser. Max Keiser, let me come to you for the first part of this second part of the show. I mean, could a new powerful super currency be created, and what would the pitfalls be in giving up the dollar as a reserve currency?
Well, the pitfalls are for the U.S. The U.S. has what de Gaulle called an extraordinary privilege. They can write checks that they never have to cash. They just print new dollars. This has been going on since Bretton Woods and the end of World War II. So America has everything to lose, and they're going to resist a new global currency every way that they possibly can. China obviously would love to be able to do their business in currencies outside of the U.S. dollar. But look what happened in the Mideast. Look what happened to Saddam Hussein when he tried to start to trade oil in euros. He was bombed and then assassinated by the U.S. Look what happened in Iran when they started talking about trading oil and gas in euros. Suddenly, America is saber-rattling in Iran. So any country looks at those examples and they say, you know, if we get out of the U.S. dollar, does this mean American Marines are going to show up in our back door and start to cause mischief? That's a legitimate concern these countries have. OK,
well, I'm not so sure the American Marines will turn up on the streets of Beijing, Max. But let's talk about this Chinese proposal and bring in Robert Scott. I mean, Robert Scott, if the Chinese say they want to base their reserve currency on this special drawing rights, the IMF SDRs, I mean, briefly, what are these rights and could they work?
Well, these rights are essentially units of account, as you said earlier, that were created, I think, in the 1960s for the IMF to essentially keep track of the reserves of other countries, creating a measure that would be less subject to the fluctuations of individual currencies. But simply that, it's an accounting construct. It's not used in any significant way now for real transactions. And for a real reserve currency, you need something that's widely traded and deep. And in the U.S. has the deepest financial markets in the world. We had, in addition to the about $1.6 trillion in dollar holdings by the Chinese, there are about $20 trillion worth of foreign investment holdings in the United States. And the U.S. investors hold about 17 or $18 trillion worth of assets invested in the rest of the world. So that's almost $40 trillion worth of investments. It is literally the deepest financial market in the world, and that's one reason why the dollar is the reserve currency of choice for most countries and most traders.
Andrew Leong, in London, let's just go back to the IMF and those SDRs. I mean, you know, the IMF is still very much US dominated. Is the IMF better placed then than most to supervise countries' financial systems in the future?
Well, I think that this is the heart of the rationale, really. Instead of almost a single dominating reserve currency issued by a single country, the IMF could assume the role of managing maybe a pool of currencies of a number of participating countries, and then denominating in these as SDRs, which can gradually be nurtured to fulfill this function as a supra-sovereign currency. The thing that the underlying rationale is that in issuing country, there is, as I mentioned before, there's a conflict of goals. If we want to expand the monetary supply for internal reasons, those reasons do not necessarily apply to the international community. Or on the other hand, if we want to tighten monetary supply, again, the international situation may dictate otherwise. So there is a conflict of goals, and to address this conflict, that an international currency, sovereign currency managed by the IMF could be in a better position to maintain the stability of the international monetary system. But of course, we can't get there all at once. It is a very bold vision, requires some extraordinary political courage. And as our colleagues were saying, there was a huge investment in US dollar denominated assets. So we are not likely to see that this will happen anytime soon. But I think that to maintain the stability of the international monetary system, it is an idea worth consideration.
You say that for this to happen, Beijing would need to have, as you said, extraordinary political courage. Max Kaiser in Paris, I mean, is China flexing muscles it doesn't have? It might have the courage, but it doesn't have the muscles and the clout, really, to dump the greenback.
What China doesn't have is gold bullion. China has only about 600 tons of gold bullion. America has 8,000 tons. The IMF has 1,000 tons. If China is serious about taking on the US dollar, they need to start buying gold bullion in size. They need to beef up their gold bullion reserves so they've got some real currency, some real heft to their backbone of their banking system. Otherwise, they're just at the mercy of the global international arbitrage and hedge fund community, and what they're saying is just should not be taken all that seriously. Until they start buying gold, don't take China seriously. That's my opinion.
Robert Scott, what's your take on that in Washington?
Well, my view is that this discussion really, I think, misses the point. We have a fundamental problem with international monetary coordination that the IMF is not addressing. But that problem is not the need for a reserve currency. It's the need to stabilize currencies in ways that correct the underlying imbalances in trade flows that have been troubling the U.S. And the global economy for the past decade. I think the best research I have seen comes from John Williamson and Bill Klein at the Peterson Institute, and they have estimated that China needs to revalue its currency by about 30%, along with a number of other countries in Asia. And I think the IMF is the only organization that can coordinate this kind of adjustment and then stabilize currencies at sustainable levels going forward. But I think this discussion of reserve currencies and SDRs, it really misses the point. That's the fundamental structural problem we have to tackle.
Let me ask you one brief question, Robert Scott, because obviously last week or the week before we heard China's worries, China's concerns about their assets in Treasury bonds. I mean, how does the US guarantee China that its assets and its investments are safe then?
Well, frankly, the U.S. has always stood by its Treasury bills, and it moved, in fact, to guarantee the investments in the mortgage-backed securities that had not been made explicitly before. China holds about $500 billion worth of mortgage-backed securities, and the federal government actually already stepped in and reassured investors everywhere that we would repay those. So I think the U.S. has very deep financial markets, as I said, and we have a very competent Federal Reserve, and China can know that those investments will be repaid. The problem China faces is that, as I say, it is going to take a haircut on the value of those investments when it finally does allow its currency to rise to sustainable levels. And that's simply unavoidable. It's a problem that created itself when it decided to acquire those reserves over the past decade.
Andrew Leong in London, just very briefly, if the Chinese proposal is a non-starter, I mean, does this sort of rhetoric play well back home on the streets of China?
Now, I don't think that it's necessarily a non-starter because this is put forth as a very serious paper, and I don't think that it's a question peculiar to China only, because there are other surplus countries putting a hell of a lot of money in the US dollar alone, and so there's it underlines the instability of the international monetary system, and that is an idea worth consideration. The question is that why China is proposing this idea now. Well, I mean, there are the G20 is coming up. Of course, it's a very good opportunity. And of course, China is now feels in a better position to propose this idea, bearing in mind that the change of global geopolitics, the global economics, when the West is seen to be in decline and China's economy is still reasonably strong, so that China has chosen, I think, this moment to put forth this idea.
OK, gentlemen, we have to leave it there. Andrew Leong in London, Robert Scott in Washington, D.C. and Max Kaiser in Paris. Thank you all very much indeed for your time. And thank you so much for joining us here on this edition of Inside Story. We, of course, welcome your comments and your suggestions. Please email them to us at insidestory@aljazeera.net. From the whole team here, goodbye for now.